Welcome to the second episode of Options Blackboard. My name is Adam Lass. Greetings to my first-timers. For those of you who have watched episode 1, welcome back. As quick background about myself, currently I serve as editor for Wavestrength Options Weekly, an options trading service based on history, economics, value, and technical analyses. I also serve as a regular contributor to Taipan Daily with our editorial director, Justice Lytle. Now, I've been trading and writing about stocks and options for more than a decade, but before that, I was just a regular business guy, just like so many of you. In episode 1, we covered exactly what options were in the first place and the basics on what they allow you to do. In episode 2, I will map out exactly how a call works, when you should buy one, when you should sell one, and the special codes you need to tell your broker what to do. But first, let's briefly head back to the beginning. In order to talk about stock options, we have to talk about stocks for a little bit. Let's invent a fictitious company. We'll call it Jackson Widgets. It's a good-sized company that makes stainless steel widgets, right? Been around since, say, 1950, has a market cap of around $1 billion and a share of $10. Here's a chart for JW shares over the past 12 months. As you can see, they've done pretty good for themselves. Shares started out around $7.50 and slowly climbed to their current $10. So, if you treated yourself last Christmas to 100 shares of JW, you're up about 33% right now and feeling pretty good about life. But you know what? You could have done better with options. Let's take a look. Now you will see a boatload of choices here. Lots of different dates and lots of different strike prices. I'll get to the whys and wherefores of picking amongst the dates and strikes in a bit, but for now, let's keep life simple. JW stock is at $10. So let's only look at options with strike prices of about $10. This is called at the money. If you exercise the contract right now, you could get a hold of shares for the same price as they are currently trading at. Therefore, this contract has no extra intrinsic value. Now let's look at dates. It takes time to make money, and so contract time costs money. This makes basic sense. You want enough time for good things to happen to the underlying stock, right? Well, the other guy knows this, so he's going to charge accordingly. At WOW, we figure that contract time is worth paying about $1 a month, as a rule of thumb. Let's say you figure to hold this option for about 3 months. As I sit to write to you today, it's August, so you would want to buy a contract dated November 2009. So the contract you are looking for will be labeled something like this. Jackson Widgets, November 10 call, JWXAB. Jackson Widgets is the underlying asset, the stock that you are looking at. November is the expiration date, that's your time limit. 10 is the strike price, and it's a call contract. Those last 5 letters in the brackets are the special identifying code you will need to place the order with your broker. Now get ready for one of those peculiar jargon things I warned you about. All stock option contracts are priced as if they only dealt with 1 share of stock. But in reality, all stock option contracts control 100 shares of stock. It was a little confusing for all of us when we first got started, but trust me, you'll get used to it pretty quickly. Now let's get back to the trade. With JW trading at $10, this $10 strike contract has no excess intrinsic value to pay for. It is dated November, so it will expire on November 18th. So you will need to sell it or exercise it any time before that date. That's 3 months of time, so you can expect to pay about $3 per share, give or take a nickel, if you bought in August. Just like stocks, option contracts generally have a lower bid, the price the guys on the trading floor will pay you if you are selling, and a slightly higher ask, the price they are charging if you want to buy. The asking price for our Jackson Widgets November 2009 $10 call, that's JWXAB, is listed at $320. That means it will cost you $320, and you now control the fate of $1,000 worth of stock for the next 3 months. Now, I'm going to tell you about a really cool mathematical formula called delta. 2 guys, Black and Scholes, won a Nobel Prize for figuring it out. Give or take a dime or two, delta tells you exactly how much you can expect this option to move in relation to the underlying JW shares. I frequently find at-the-money options like the one we are looking at today carrying a delta between 0.60 and 0.70. That means you can expect the option to go up 65 cents for every dollar the stock climbs, times 100. Now here's where it gets really cool. Let's say that Jackson announces a really favorable labor contract and shares go up $3. It made you a gain of $300 on 1,000, roughly 30% on your stock holdings. But that same $3 pop in JW shares raised the selling price of your option contract to $500. That's $180 in your pocket, a 56% option gain. That is an 87% improvement over your stock's performance. Better yet, you risked a third as much money to get it, and the numbers just get better from there. Let's say Jackson announces a new contract selling widgets to South Korea. The news drives JW shares to $20. Now, most any trader would be pleased with a 100% gainer. But I've got to point out that once again, the option gain dwarfs the stock gain. The $320 you spent up front has now grown to $920. That's a gain of 187.5%. That's the big secret about options. If you are willing to learn a few simple buzzwords and master some pretty straightforward arithmetic, you can dramatically reduce the cash you risk while almost doubling your gains percentages. Right about now, folks usually ask me a really important question. What if the stock goes down? The answer is even better. I'll explain why when we get into buying put options in the next episode. Until then, please feel free to send additional comments back to me at adam@taipandaily.com. Thanks again for joining me, Adam Lass, in the second episode of Taipan Publishing Group's Options Blackboard.